Hey traders, one of the things that we talk a lot about in our live trading room is creating an edge or an advantage in our trading. And I do believe, I am of the belief that short selling stocks can be, if done properly, of course, something that gives you that edge. So let's jump in. Let's take a look at why I feel like you should always have some short delta positions on in your portfolio. Okay, let's jump right into it. And again, why I feel like I pretty much perennially, doesn't matter really what the market's doing, I always carry a certain percentage, and that percentage ebbs and flows, of a short delta or a negative delta or short positions in my overall portfolio. Back in the day, when these amazing, mythical, magical investment vehicles came out called hedge funds, and they were black boxes and nobody knew how they were so amazing, but they were amazing. Well, a lot of them, as they came out of the gate originally, were just 60-40 plans. They were 60% long, 40% short. It smoothed out the delta of the overall position. The equity curve was a lot smoother and more stable. That's all really short selling can do, is that it can balance out those longs. So let's take a look at a couple of reasons why. Number one, I think that you should initiate a short portfolio within your bigger portfolio right now. And maybe some of the economic reasons why maybe now is a really good time, although I think any time is a good time to balance out your long delta risk. So the question is, can you build a powerful short portfolio with a very small account, and why I believe that you should always have, at least again, a small portion of your portfolio in a negative delta position. So number one, I know this sounds obvious, but if you think about it, it can be an epiphany of sorts. It's easier to find losers than it is to find winners. If your goal is to always find, if you bemoan the fact that you didn't get in Bitcoin when it was $20, or you didn't buy Microsoft or Amazon or Tesla or Apple or on and on and on and on when they first came out onto the marketplace, and if I would have just put 5,000 in this company or this company, I'd be a millionaire now. Well, good luck. If your goal is to try to find the next Apple or the next Tesla or the next Amazon or Microsoft, but if you're looking for losers, if you're looking for companies that have a high propensity to go down and potentially go to zero and go bankrupt, well, that's easy. It's pretty easy to find companies that do nothing but lose money. So I think, first of all, it's easier to find losers than winners. Number two, the vector of the move is usually bigger to the downside than the upside. You guys have all heard the adage that the stock market takes the stairs up and the elevator down. You rarely turn on the nightly news and hear the newscaster say, well, the market crashed up 1,000 points today. The big, massive moves are usually to the downside. And so it gives us actually a higher profit potential when we're shorting than when we're long, generally speaking. Number three, the shares are scalable from a buying power perspective. My goodness, you can go short one share of stock. I'm going to show you our model short portfolio here in just a second. You'll see the ticker symbols that we're in as a trading room, but there's all kinds of companies out there that are doing nothing but losing money, that have bankruptcy on their radar, that are $5 a share. You could go start a short portfolio with $20 and go buy 3, 4, 5 different shares of these different companies. You could have a diversified portfolio of almost a half a dozen positions for $20 or $30. So buying power does not have to be an issue. Number four, they're very easy to dollar cost average. If you're shorting 1 or 2 shares at a time, you can get that sort of inverse dollar cost averaging going on, where if it continues to go higher, you can improve your cost basis. Commissions. Most major brokerage firms today don't charge commissions for equity trades. They do for option trades. So it can be a little better for our pocket, our wallet on the commission aspect. If you do have enough buying power that you can get to a short position of 100 shares, well, at that point, you can start to cash flow it. You can start to sell covered puts against it. That just accelerates the income process. Next, it does take advantage of people's absolute biggest fear in the market. What is their number one fear? Markets crashing, or what I hear a lot is a black swan. Well, how would this strategy work? Or how would this strategy work? Or what would your performance, everything you're showing me looks really good, but what would your performance do in a black swan? Okay, number one, black swans happen 1 out of every 2,000 trading event days. So if you're building a portfolio to protect you against a black swan, you are absolutely positively guaranteed to never ever make any money, because the insurance will override those other 1,999 days of profit. You really should be in something that I have done for decades. My bottom line number on a yearly basis is everybody should be making 9% a year. That's bottom line minimum. Peer-to-peer lending programs like Prosper.com, fractional ownership of real estate or lending with a company like Groundfloor.com. I have got almost 2 decades of personal investing experience with these companies. 8, 9, 10, 11, 12% a year, year after year after year. So if you're really worried about crashes, you know what? You're probably an irrational investor. To my knowledge, every single solitary crash the market has ever had, we have not only recovered from, but gone on to another all-time high. So it's just a process in the marketplace. We love the fact that that risk is there to begin with. Otherwise, we wouldn't make any money. You have to have risk to have reward. But if you're really worried about things like black swans, number one, get your money out of the marketplace. Go to a fractional lending or a peer-to-peer lending program like I just talked about. Or number two, set yourself up so that you can just go to bed at night praying that we get a black swan. How great would it be for a short portfolio if the market crashed by 50%? It would be great. So it takes advantage of everybody's biggest fear, which is, oh my gosh, the market could crash at any time. The last one here is, I think, more appropriate. Crashes do happen. Now, black swans, maybe 2000, we had a black swan, but honestly, 2008, biggest financial crisis we ever had in the history of the entire financial economic system. There was no black swan there. It was a crash. Black swans, that's an irrational fear. Crashes, that's very rational. And I'm talking about a 10 to 30% drawdown. Those can and do happen all the time. So why not have at least a portion of your portfolio set up to take advantage of those opportunities? So that's a lot of the reasoning behind why I think that we should take a look at setting up a portion of our portfolio with a negative delta. Why is now a good time? I have said that I have almost always perennially held some short positions in my overall portfolio. We run a program called the ATM program. The asymmetric trade management is a passive investing asset allocation model built much on a hedge fund philosophy where we do have short and long positions simultaneously. So I think it's always a good time, but I do think that there are some very, very critical things happening in our economy right now that if you understood them, you would feel foolish if you didn't have some short positions working for you. What are they? Why is it that I think now is a good time? Well, number one is the inverted yield curve. We've got a huge inverted yield curve right now where the 2-year is yielding more than the 10-year. Now, there's no guarantees in the marketplace, and there's all kinds of indicators and prognostication tools that you can use to try to divine what the future market situation is going to look like. Again, nothing has a guarantee, but I will tell you this. We haven't had an inverted yield curve in the last 40 years that has ever been wrong in predicting a recession. Not one single solitary time. Last 40 years, every time the yield curve has inverted, we've gone into recession. Some people may say we're in a recession already. I would not debate that. But I'm telling you right here, this is flashing recession. It's flashing recession. So we've got that going on. Housing numbers and durable good numbers right now in this economy are absolutely horrible. We're going to talk about the impact of housing on the economy in just a little bit, but the numbers for all of these are just absolutely horrible. The consumer is not in a good place, and part of it is housing. How important is the single-family residential home to GDP, gross domestic product, or the total economic impact? Well, it affects the real estate industry. It affects places like Home Depot and Lowe's and home improvement purchases. There's other related home expenditures that go into owning a home. Obviously, there's a lot of profit and revenue driven by new construction of homes. A house is a depreciating asset. Land is what appreciates. Houses fall apart. And so new construction drives the economy. Every brand new home sold in the United States of America on average delivers almost $113,000 of economic benefit to our GDP, our bottom line. It's our economy. Single-family residential homes are the number one economic driver in the economy today. And housing ain't doing very well right now, okay? The next one, Fed funds are going to 6%, or are they? We don't know. We don't know yet, but that's not good. And what's really interesting is that the CME rate watch here, we were pegging interest rates. The Fed was going to raise interest rates up to 500 basis points or 5%. And then the consensus went to 5.25 to maybe 5.5. Very quickly, it's gone from 5.5 to 5.75 rates. And just now, Powell spoke today in front of the annual congressional report, summary and review. And now, wouldn't you know it, we are factoring in about an 8% probability that we go to 6% on the funds rate. That was a 0% probability before he spoke. Now it's at 8%. Okay. This will choke and kill housing. It will absolutely kill housing. We'll show you some other examples with that in a second. The other thing is the 1-year bond right now is yielding, I can't update the PowerPoint quick enough. There was yielding 5% last week when I put this slide together. So now it's up closer to 5.5%. Versus the S&P yielding 1.67%. So if you watched our training video on the in the money cover trade and why we think it's such a good trade, part of it is because of the Sharpe ratio. So if you're not familiar with the Sharpe ratio, go check that out. The Sharpe ratio, it measures whether or not you are getting compensated for the risk that you are taking, okay? So the S&P 500 right now, there's no guarantees of growth, but you do get a guaranteed dividend. The dividend on the S&P 500 right now is 1.67%. The market can and does crash by 30-40%. So are you really interested in putting your money in a place where you could potentially lose 40% of your principal for a 1.67% a year gain versus you could put your money in a 1-year treasury at 5.5% interest, 100% guaranteed. 100% guaranteed. This is when you start to see markets crash. When people say, why would I take risk in the market when I can make X amount over here? Not just safely, but guaranteed, right? How important is that number? Well, here's the last time we've seen numbers like this. Here's the last time that you could go get 5 or 5.5% return, risk-free, 100% guaranteed. Happens to correlate with the crash of 2008, probably the worst financial crash we've ever seen. It outstripped the crash of 1929. Well, guess what? We're right back there again. The red line is the stock market. The blue line is where we're at interest rate wise. You're taking an awful lot of risk in this marketplace versus something that is right now yielding 300% more and is completely risk free. It's not a good sign in terms of looking at where the stock market is valuation wise. Okay. In addition to that, we talked about homes and how much of a driver single family residential is to the economy and the GDP. Homes today are 50% more expensive than just a few months ago. And you say, wait a minute, that's not the news I'm hearing out there. I'm hearing that real estate is crashing as interest rates rise and demand is softening, and it's now flipped from a seller's market to a buyer's market. That's true. But those homes are 50% more expensive. What do I mean by that? Well, interest rates have jumped by 100%. They've gone from 3% to 6% interest rate. So now that that home that you were going to buy for $250,000, well, it's going to cost you $128,000 more. The home that you're going to buy for $500,000 will now cost you $256,000 more. The $750,000 home will cost you $384,000. That should be thousand right there more. I can't buy. I do not live in a castle. I do not live in a castle, and you cannot buy homes for under $1 million in my neighborhood. Used to be down here, but homes are just doing nothing but getting more and more expensive. Inflation is rampant. It is out of control. Interest rates are continuing to rise. Single-family residential homes, number one driver of economic GDP numbers that we look at. It's very, very critical. If you look at the correlation here, the red lines are where residential property values are. The gray line is the GDP of these major nation states, Switzerland, Germany, the United Kingdom, United States. You see the correlation. You see the correlation. As property values go, so goes the GDP. As the GDP goes, so goes the stock market. There is a huge, massive correlation there. Let's talk about another indicator that I think is a very leading indicator. So many indicators, so many technical indicators, so many economic indicators are lagging indicators. They're just aggregating historical data. One of my favorite leading indicators is the cruise indicator. It really is tremendously accurate on where the economy is headed going forward. Not looking at it in the rearview mirror, looking at it going forward. Now, what is the cruise indicator? Basically, it's this. The idea of the cruise indicator is that cruises, going on a cruise, is generally not a cheap endeavor. You can find some deals out there, of course, but generally cruises are fairly expensive. And they are absolutely a luxury, not a necessity. In hard times, people pull back on luxury items and focus on necessities. We focus on keeping gas in our cars, keeping the roof over our head, keeping the utilities on, and food on the table. So in good times, we spend monies on luxury items. In bad times, we pull back from those spending. So the cruise indicator, how well the cruise industry is doing, how booked up are they, how profitable and healthy are they as cruise operators, is a very good indicator, or a pulse, taking the pulse, if you will, on the economic situation that we're looking at. Well, here's your major ones. Here's Royal Caribbean, Carnival Cruise, and Norwegian. Their financials are all teetering on bankruptcy. Now, let's be clear, COVID did not do them any favors, but that has come and gone. And they are probably, right along with movie theaters, never ever going to see the peaks that they've seen previous to COVID. So this whole entire industry is flashing a sell signal in the stock market. All of their financials are just horrible. So again, we talk about the reasoning the rationale, if you will, for building a short portfolio. It's easier to find losers than winners. The downside's bigger than generally upside. Easy to scale 1-2 shares at a time. Very dollar cost averaging efficient that way. Low to zero commission costs. You can cash flow it with options, covering them with puts if you have more than 100 shares. It directly addresses people's biggest fear of putting money in the marketplace. What if the market crashes? And now you can take advantage of it. So those are a lot of things that we look at. I want to show you a couple simple examples here, and then we'll jump into our model portfolio, and I'll show you what we're actually trading right now and kind of how it's going for us. So Carvana is an example that we have in our portfolio right now. Carvana is an interesting company. These are probably buildings that you have recognized as you've driven by them. They're very interesting and obviously eye-catching. Carvana sells cars, and it's in the car business. And Carvana has two very interrelated, interesting situations going on. Number one, they're growing like crazy. They are growing by leaps and bounds. This is a company that has been doubling and tripling in size year over year as it got started right out of the gate. That sounds great, but the other accompanying issue that they have that is intertwined with that is that they lose money on every car they sell. They are their profit margin is not low. Their profit margin is negative. They actually lose money on every car they sell. So you can understand the conundrum when you are selling more and more cars faster and faster. The better your business does, quote unquote better, the more cars you sell, the faster you ramp up your losses. And you can clearly see this here. From 2014, we went from 15 million in losses to today they're losing, or headed towards losing, close to $2 billion a year. Okay. Furthermore, you look at it in the future, there's nothing. There's nothing in the future right now that would imply that this is going to turn around for them. Can you imagine trying to find a company that is in the marketplace today? You know, it's coming out today. Let's say 2014's today. It's coming out. You say, it's got 15 million in revenue, but that was due to a lot of really one-time upfront promotions. Really, this is a company that's bringing in $4 million a year. I know individuals that are bringing in $4 million a year. This is not a big company, right? But don't worry, because in a few short years, they're going to grow 4 million in revenue to almost 2 billion. See, there's your Apple, there's your Tesla, there's your Amazon, there's your Microsoft. But good luck finding that company. But if you want to invert it and look at it from the short perspective, these are out there all day long. This is a company that's teetering on bankruptcy. Another example is Lyft. Now, Lyft, you may say, well, it's the same industry. They're getting hit. No, it's a different industry. Lyft is in a absolutely, the used cars, but it's in an absolutely different industry. You can sort of see the same thing here with Lyft. They start off, they got 343 million in revenues, and they lost almost 700 million. Now, that's ugly, but that's how a lot of startups work out of the gate. That's how Amazon lost money for a long time before it was able to get economies of scale and turn a profit. So you give it some slack. You say, okay, we'll give it a few years. This is kind of nice. It almost tripled its revenue over the next year, almost doubled it the next year after that. It had a little blip there in 2020 as we had COVID come in, but it rebounded quite nicely from that. And now we're at almost 4 billion in revenue. We started just a few years ago with 300 million. Now we're at 4 billion. That sounds like a great growth story to me. Well, they're bringing in 4 billion in revenue, but they're losing 1.5 billion every year to the bottom line. And that loss is not necessarily increasing exponentially like we just looked at with Carvana, but it's not a good trend. It's not a good trend. Okay. So let's jump into our model portfolio. I'll show you what we've got going right now. So this is our model portfolio right now. And, you can see, first of all, that on these positions, 3 shares, 2 shares, 4 shares, 5 shares, 5 shares, 6 shares, 2 shares. There's a big one, 10 shares right there on Nikola, 20 shares on Space. But you can see a lot of these are very, very small positions. And what's interesting to me is while we've had a couple of down days recently in the marketplace, from January of this year up until today, the S&P's been up almost 10%. We're annualizing out at a 40% potential return on the year this year from the S&P 500. Now, again, I don't think that's going to happen, but I'm just saying we're off to a pretty darn good start for the year. And yet we are killing it here. We are killing it in this short portfolio. So a couple items of note. Again, this is actually built. We have built this model portfolio here in my teenage son's account. This is my actual teenage son's account that he is trading these shares in. And he's got just a little bit under $3,000, about $2,700 or so of committed capital to this trade. You could scale it starting with $20 if you wanted to. You can scale it to millions if you wanted to. So buying power wise, it's very easy to scale. And I think the thing that's interesting is twofold. Number one, we're absolutely crushing our ROI on this trade versus the stock market. We're about 400% higher than what the S&P is year to date so far. But number two, I think, look how much green we have in there. VST has had some news that's actually pushed it up a little bit, but not a big deal. I'm only short 8 shares. You can see where my cost basis is on that. It's at about 23.76, and we're up here at about 26 or 27. I'm going to go into this account tomorrow and short another couple shares to dollar cost average that position. But this is where we're at right now. These are the ticker symbols that we are using. And again, I think it's important to note that every one of the training videos that I give you guys, everything that we do in the live trading room is live. It is real with real accounts, real money, no virtual trading done in here. So that's kind of my whole pitch and reasoning behind shorting. One other thing that I will just throw into the mix here. This little guy right here is our national debt clock, and it doesn't look good. There's a couple of things that I'll point out. Obviously, number one, the big one, we're about $31 trillion in debt. But here's what's interesting about that debt. The country is in debt. Who is the country? Who's responsible for that debt, and who pays the debt? There is no country. There's us. There's you and I as U.S. citizens. We are the ones that are responsible for that. You want to know what your responsibility of that 31 trillion is? The debt per taxpayer right now is about $246,000. So if you pay taxes, you're on the hook here for about $250,000. If you're a child or someone that is not in the labor force anymore, you still carry a burden of almost $100,000. So let's put it to you this way. Let's say that you took out a $246,000 loan from the bank, and you went to the racetrack and you spent it all. You lost it all. You have no money. The bank comes to you one day and says, your loan is due and payable in full. What do you do? What do you say? Well, you say, well, I don't have any money. I can't pay you $250,000. I don't have it. What happens after that? It's called bankruptcy. It's called bank. I would submit to you that because we cannot pay our bills, this country is bankrupt. To further illustrate that, if you come over here and you look at our revenue coming in, this is again a very interesting point to look at. Our U.S. federal spending right now, we're spending about $6 trillion a year. Okay, we're spending about $6 trillion a year. That's our outgo. What is our income? Well, income comes from federal taxation. Our federal tax numbers are about 4.6 trillion. So we're spending 6 trillion, we're bringing in 4.6 trillion, and each one of us are $250,000 in debt. So if you were in this situation where you had zero money, you had no money, You owed $250,000 in debt, and you are making $460,000 a year, but you're spending $600,000 a year. How tenable is that? How lasting and permanent is that? There's no permanency. This will not abide. This will not abide, as the dude would like to say. It's just something that's not going to be sustainable. That will eventually come home to roost. So for me, what it means is I believe it is safe, it is prudent, it is wise to have some portion of your money in a short setup. We would love for you to come participate with us as a live trading group and see how we're setting up our portfolio, how we're putting our underlyings together, how the asset allocation model works, what our day in and day out P&L looks like. If you want to come visit us, hang out with us for a week, trade live with us, you can go to try0dteforfree.com. Chat with us. We got hundreds and hundreds of members here. You can ask each and every one of them, is this program legit? Does this work? Is this something that is valuable to you? Come trade with us for a week. Check it out. If you like it, I think you'll stay. Hope you guys have a good trading week. We'll talk to you soon.